It's okay. It's been beautiful. I like it. We have nothing to complain about. Yeah, my daughter is in Rochester, New York. It's been around 0 degrees. It's warming up to 20. My sister lives in the Cleveland area, and that's been around 0 degrees, snow, and it's warming up into the 20s and might even rain. It'll freeze over. It's going to be just a skating rink. They have nothing to complain about. All right. So, not this past Sunday, but the Sunday before, there was an article in the Orange County Register by Jonathan Lansner, and he's always writing about Orange County real estate. We distributed that to everybody. We put together scripts and other things. But now I want to go over that and help you further, because I think that article is really helpful for us when speaking to any sellers, because it's not us just telling sellers. Now we have third-party validation in regards to what our presentation is going to consist of. So let's talk about that. So once again, it's based upon that article, today's discussion, and the scripts that we've composed are also based upon what's taking place in the marketplace. So let's begin with a headline stating Orange County is now officially classified as a buyer's market. So what does that mean in concrete terms? Well, according to Redfin's 2025 data, we have 21% more sellers and buyers in our market. Specifically, 6,943 sellers competing for 5,759 buyers. So when you look at the 50 major markets Redfin tracks, Orange County ranks 33 in terms of the seller to buyer gap, which means we're in the middle of the pack nationally, but we're clearly and definitively tipped in favor of buyers right now. So that's not my opinion. That's not my feeling. This is hard third-party data showing that sellers have lost a significant advantage in regards to pricing leverage. So that's the foundation of every conversation you're going to be having with sellers after today. So understanding the metrics. Slide 3, Carlos. Sorry. I'm ahead of you. Thank you. Now, some of you might be wondering how Redfin calculates this, because how do you determine the number of buyers? Well, it's different from the traditional metrics. Usually Zillow, Realtor.com, they go back 60 days or so and they calculate just how many buyers there were, as a matter of fact, at that point in time. And also the homes actively listed, that's easy to determine. So when determining how many buyers and sellers there are. So with that said, Redfin uses statistical analysis to determine just how many active buyers there are. And from what we've read, or I've read, it's much more accurate than going back 60 days to determine the number of buyers. But their definition, Redfin's definition, is very clean and clear. If there are 10% more sellers than buyers, it's classified as a buyer's market. If there are 10% more buyers than sellers, then that's a seller's market. Make sense?
Yes.
Of course, anything in between is considered balanced, but in Orange County, at 21% more sellers than buyers, we are firmly, unambiguously in a buyer's market. So this is the metric you're going to hear me citing over and over again during today's discussion, and it's something that you should be using. But let's talk about California's statewide picture. The buyer's market condition is not just an Orange County phenomenon. It's a statewide pattern. When you zoom out to look at California's 8 major metros that Redfin tracks, the statewide picture shows 35% more sellers than buyers. So that's 72,840 sellers versus only 54,045 buyers across the state. So that's a massive supply or surplus over the number of buyers that are out there. So only 2 markets are currently balanced, and that's San Francisco and San Jose. And that's exclusively because of the booming artificial intelligence aspects that are in the tech industry.
Can I ask a stupid question?
If you prefer stupid questions, that's fine. I'm sorry, what?
How do they define the buyer? Is this before the transaction or after the transaction?
It's statistical analysis.
Statistical analysis.
That's why. That's how Redfin gauges the number of buyers that are out there. But it's interesting. I think Jonathan Lansner, whether he's right or not, he's been writing these real estate columns for 30 years or so. He's using this information, and I think that when based upon a look back, Redfin's statistical analysis tends to be more accurate than what other sources provide information in terms of what the number of buyers consists of. As I said, sellers, it's very simple. We know how many properties are on the market.
But buyers, right?
Well, the whole point of today's discussion, you can debate it all you want, but we have a third-party source, and that's exactly what we're trying to do here, because when we're sitting in front of a seller and we're trying to tell them what they should be doing per se, what are you basing it on? No one's got an answer to that. Now, actually, the Orange County Register did us a real favor by publishing this article indicating there's a complete imbalance in regards to the number of buyers and sellers. And there hasn't been anybody in Orange County besides my grandson, who's 15 months old, that is not familiar with the Orange County Register. So it's a valid source. It's a third-party source, and that's what we should be relying on. They may have some other information, but it's probably not going to be any more accurate than what we're talking about. Not only that, but we see what's happening in the marketplace. So there's no reason for us to not rely on that information that's being published.
Hey, Richard, quick question. So these numbers from sellers and buyers, what is the period?
December of 2025.
December 2025. Okay, thank you.
Yes. So when your seller says, I heard California real estate is still hot, you can confidently and factually say the current data shows that it is a buyer's market. So a regional comparison, so we're on slide 5, Carlos. So let's drill down and look at how Orange County compares to our neighboring Southern California markets, because context matters when you're describing this to your sellers. The Inland Empire has the biggest seller surplus at 54% more sellers than buyers. That's the most competitive and challenging market in the entire region. Los Angeles, 46% more buyers than, more sellers than buyers. San Diego's at 22%. Orange County is at 21% more sellers than buyers. So while we're in better shape, we're still in a highly competitive market in which buyers have many choices, as a matter of fact. So what does that mean for sellers? Well, in real world terms, are you raising your hand?
Just a quick question. Just want to clarify, is that the Los Angeles County or city?
County, which would encompass a far greater region, as a matter of fact. And like the Inland Empire also. Does the Inland Empire, and I guess this is a question for the audience to answer, does that include Corona? All of Riverside? So I think the answer is yes. No, San Diego's separate. That's a 22% imbalance. All in there. Yes. Yeah. So we have clients in those areas. So that's something to give consideration to. You think about it, 54% more sellers and buyers in the entire Inland Empire. That's a huge disparity. Yeah, it is crazy, but that's what we're facing, as a matter of fact. So what does that mean for your sellers? First, more competition. Buyers have multiple options in every price range at every neighborhood, which means they can afford to be selective and patient. Reduced pricing power for a seller. If a home is overpriced by even 3 to 5%, buyers will simply move on to better value without even negotiating. They don't need to negotiate because they have choices. Third, extended market time. The article specifically notes, and this article is just completely invaluable, and I hate to continue to say that over and over again, but now we have some third party that's validating all the things we're trying to tell our clients or potential sellers. But the article specifically notes that homes priced incorrectly are taking 2 to 3 times longer to sell than properly priced properties in the same area. And fourth, this is the key insight from the article, sellers' refusal to cut asking prices in an unaffordable environment is a primary reason sales activity is running near generational lows. So in other words, unrealistic seller expectations are causing listings to sit, and that stagnation is hurting everybody, sellers, agents, and the market overall. So it's your job to prevent your listings from becoming stalled inventory. Opening market explanation. We're on number 7. Thank you, Carlos. Now let's go from data to execution. This slide gives you the exact opening statement for every listing presentation you conduct from now on. So you need to commit this to memory, write it on a note card. I have notes myself in front of me because I can't remember all this, but you need to rehearse this or keep this presentation on your laptop or on your tablet. But you say right now, Orange County is classified as a buyer's market because there are more homes for sale than active buyers. About 21% more sellers than buyers according to Redfin data cited in the Orange County Register. So this accomplishes several things. First, you're framing the entire conversation with objective third-party data, not your opinion. Second, you're citing a credible source, the Orange County Register, which every seller has probably heard of. Third, you're setting realistic expectations from the very first 5 minutes of your appointment. And fourth, you're positioning yourself as a market expert who understands what's actually happening, not someone who's going to be blowing smoke where the sun doesn't shine. And tell them what they want to hear. This is your opening move, and it's critical. Next one. Pricing strategy discussion. So after you've established the market context, you move directly into the pricing strategy discussion. Here's the language, and we're going to distribute all this so you have the opportunity to continue to read over it. My job is to help you win in the market we actually have, not the one we remember for a couple of years ago. This acknowledges that sellers, and this is in the article once again, are mentally anchored to the 2021, 2022 pricing, but it redirects them to today's reality. So then you continue. In the article, the columnist points out that sellers who refuse to adjust prices are a big reason sales are near generational lows. Buyers just move on to other options. So you're citing the article once again, reinforcing credibility. Then say, because there are more sellers than buyers today, if we come out too high, buyers will simply skip your home and choose one of the many alternatives. So that's a consequence if they don't price properly. So it's not theoretical, but it's actual. And you close with, you control the price and condition. The market controls the result. So in this buyer's market, realistic pricing is your biggest advantage. So this positions pricing as a strategic tool that it is, not as a concession. So you're helping them understand that pricing is the variable they control to achieve the outcome they want. Next one, please. And of course, isn't it still a seller's market? What seller out there doesn't think it's still favorable for them? So you're going to continue to hear this objection in every listing presentation. But isn't it still a seller's market? I thought real estate was still hot. Well, here's how you handle that. So use facts, right? Acknowledge their perception. So it tells them you're listening. So that's a great question and a very common perception. So we're in a strong seller's market, and that memory sticks in people's minds. You're validating them, not dismissing them. Then you present the current reality. However, this recent analysis shows that 36 of the 50 largest U.S. markets, including Orange County, now favor buyers because there are significantly more sellers than buyers. So you're using national context to show that this is not a local anomaly. Then drive home the point. When you have 21% more sellers in Orange County, there it is. That is not a classic seller's market. Buyers get to be picky and negotiate harder. Is there anybody who's been working with the seller or buyer that hasn't noticed that buyers are really difficult to deal with? And they're negotiating much more in a much more aggressive fashion. And then you close with the consequence. If we price like it's still a hot seller's market, we risk sitting on the market and ultimately netting less than if we had priced appropriately on day one. So that's respectful but firm, and it grounds the conversation in facts, not feelings. If anyone's looked at the MLS and you're searching for a particular property, do you see how many down arrows you're seeing in the MLS? It's incredible in regards to what's happening. So those people have lost the most valuable time with a new listing, as a matter of fact. Whether that's the agent's fault or the seller's fault, you can come to your own conclusion. Setting adjustment expectations. So one of the smartest things to do at a listing appointment before any problems arise is to pre-frame the possibility of a price adjustment. Don't wait until 6 weeks later when the listing is stale and the seller's frustrated. Set the expectation up front. So here's what you should be saying, because you can't get them to adjust their price initially. One other important thing I want to agree on up front is how we'll respond if the market doesn't give us the feedback we're looking for. Because we're in a documented buyer's market with more sellers and buyers, we need to listen carefully to the response in the first few weeks. If we see low listings or showings, weak online engagement, and you can go to Zillow, you can see how many people are looking at properties when they're searching. So you can use, once again, third-party documentation, not just you saying that, but say, hey, this is the number of views we've had on Zillow. Like properties are getting far more views. So there's a problem here. There's a reason. So can we agree that if the activity doesn't match the expectations, we'll sit down quickly and review the price instead of letting the home sit and go stale? So get that verbal agreement or acknowledgement right then. When you have to make a price reduction call in 3 weeks, then remind them of the discussion that you've had. The price reduction call. So when the time comes in a will, the property is overpriced, to recommend a price reduction, you need a structured framework so you don't just wing it or stumble. So follow this 4-step process. Step 1, frame the conversation by citing the article and market data. The Orange County Register article confirmed we're in a buyer's market. 21% more sellers than buyers in Orange County. You're immediately grounding the conversation in objective reality. Step 2, present the objective data specific to their listing. Since we listed, we had X number of showings and X number of serious inquiries. In a market where buyers have many options, that tells us we're not competitively positioned. You're not saying that they're overpriced. You're saying that the market is telling them that they're overpriced. Next step, state the risk clearly and directly. The article says sellers who refuse to adjust prices are driving historically low sales. I don't want your home to be part of stalled inventory. So now you're framing the inaction as the riskier choice. In step 4, recommend specific action. A timely adjustment to, say, $1 million from $1.2 million repositions you competitively and gives a fresh opportunity with buyers. So you're being directive, not tentative. So if you think you need a price reduction, give them a number. Don't just say, well, we should consider price reduction. You should know what it should be reduced to. Slide 12. Responding to resistance. So you recommend a price reduction. Some sellers will push back. They'll say things like, hey, we can't afford to sell for less. Has anyone heard that before?
Yeah.
Yeah, last week, 2 different people, as a matter of fact, that came into me. Or let's just wait a little longer and see what happens. Here's how you respond with empathy but firmness. You say, I completely understand wanting to protect your equity. That's my goal as well. You're acknowledging their concern is valid. Then you educate them. At the same time, the markets, not agents or sellers, is what determines value, especially when buyers have options. You're taking yourself out of the equation. This is not about your opinion as the agent. Then you present the consequence. Staying at a price that the current buyer pool rejects usually leads to more time on market and a lower eventual sales price. I don't think anybody in here can dispute that. So adjusting now is about maximizing your net, not giving money away. We are reframing the price reduction from a loss to a strategic move and to protect their financial interest. So you're positioning yourself as a professional who understands the long game, not someone who's just trying to get a quick close. And then using broader market data. This is script 13 or slide 13, right? Sellers sometimes need to hear that their experience is not unique, that this is a broader market pattern, not something specific to their home or neighborhood. So this script gives you this context. So you say, this isn't just Orange County. The same Redfin metric shows that across California, 8 major markets, that there are 35% more sellers than buyers. So now you're zooming out to a statewide level. Let's say the columnist calls it relatively good news for house owners and a concern for sellers because of the added competition. So now you're quoting the article directly and you close with, so what you're experiencing isn't unique to your home. It's a broader shift where sellers who adapt on price get sold and those who don't tend to sit on the market. So this removes the emotion and personalization from the conversation. It's not that their house is flawed or anything of that nature. You're basing it on actual statistics and a third-party observation. So it's much better than you saying, no, your house looks like shit, we just need to reduce the price. So call to action. At the end of your listing presentation, after you've presented the data, walked through the scripts, and discussed pricing strategy, you need to close with a clear, confident call to action. Here's the language. Given everything this article and the data show, more sellers than buyers, a clear buyer's market, and slower sales when prices don't adjust, our plan is straightforward. We'll launch at a price that reflects today's buyer's reality, monitor the response closely, and be ready to adjust quickly if the market tells us we're out of line. If we follow that plan, we put you in the best position to sell your property in this buyer's market, instead of becoming another listing that has to chase the market down. Take a picture of the homes that are on the market. Let them see all the red arrows, or have your laptop there. Let them see what's going on, as a matter of fact. So this is your value proposition. You're not just listing homes and hoping for the breast. You're bringing market intelligence, strategy, and a willingness to have a difficult conversation with these clients. So that's what separates you from an order taker and being a professional agent. So, recommended strategy. Our recommended strategy is the office. Let's talk about our office's strategic pricing philosophy for the market. With 21% more sellers and buyers, traditional at-market pricing is not enough to create urgency or competition. Our recommendation, and I want you to present this confidently when you're speaking to them, is to price 2 to 3% below comparable sales, not at market, not above market, to leave room for negotiation. Why? Because in a buyer's market, you need to create urgency and competitive demand. And the only way to do that is to make buyers feel they're getting this exceptional value. When you price below market, 3 things happen immediately. First, you attract the maximum buyer pool because your listing shows up in more price filtered searches online. Second, you generate excitement and a sense of opportunity. Buyers think this won't last. And third, you create real competition among multiple qualified buyers, which drives the final price above your initial price through competitive bidding. This isn't giving money away. This is strategic positioning that should net in greater proceeds for the seller. The next slide, psychology and competitive pricing. So let's talk about the psychology behind below market pricing, because this is what makes it work. When buyers see a home price 2 to 3% below comparable properties, 4 psychological triggers activate. First, exceptional value perception. They immediately think this is priced better than everything else I've seen. I need to act now before someone else gets it. Second, fear of loss. In behavioral economics, the pain of losing something is psychologically twice as powerful as the pleasure of gaining it. So when buyers perceive a great deal, they fear losing it to another buyer, which accelerates their decision-making and willingness to pay more. Third, maximum showings instead of 5 lukewarm showings. From bargain hunters, you'll get 15 serious showings from motivated, qualified buyers who see real value. And fourth, true competition. When multiple buyers submit offers, you're not negotiating one-on-one. You're creating an auction dynamic where buyers compete against each other. And that bidding pushes the final price up. So that's the power of strategic pricing. So if you have no offers, are you actually negotiating with anything? Nothing. There's nothing to negotiate if you don't have any offers. And that's something to tell your sellers. Leverage, week 1 attention. So here's a critical stat every seller needs to understand. Research consistently shows that 80% of showings happen in the first 14 days a home is on the market. Why? Because when your listing goes live, it triggers automated MLS alerts to every buyer and buyer's agent who have saved searches in that price range and location. Your home appears as new in all major real estate apps and websites. You have a maximum visibility and excitement. This is your golden window, the most valuable 2 weeks of your entire listing period. If you waste that window by testing a high price, you burn through the motivated buyers who are waiting for a home like yours, and they move on to other properties. Once you're past 2 weeks, You're no longer new. You're no longer generating automated alerts, and you become just another listing competing for attention. That's why you never waste week one by testing the market. Price it right from day one, capture that surge of activity, convert it into multiple offers. Miss that window and you're fighting an uphill battle. The next comment, but we want full value. One of the most common seller objections to below market pricing is, but we want to get full value for our home. Why would we leave money on the table? Well, here's your confident data-backed response. You say, I completely understand. Maximizing your net proceeds is exactly what I want too. Here's what the data shows. In a buyer's market with more sellers and buyers, pricing strategically below market actually nets you more money, excuse me, not less. But it creates competitive bidding that pushes final price above your target. Then continue and say, when you overprice and test the market, you lose the week one surge of motivated buyers, the ones most likely to pay top dollar. By the time you adjust the price, those buyers have already purchased other homes. You end up chasing the market down and netting less. And you close with, strategic pricing gives you control over the outcome. Hope is not a pricing strategy. Can you say that to somebody? If you can't, you may not be successful selling their home. Competitive positioning. Let's price it to win, not price it to sit. So that reframes the below market pricing from a concession to a tactical advantage, and it speaks directly to their financial outcome. And that's all they care about. Pricing for maximum net proceeds. So let me summarize the bottom line message you need to deliver in every pricing conversation. You say, in a buyer's market, and this, you're going to hear this theme over and over, with 21% more sellers than buyers competing for attention, pricing 2 to 3% below market isn't giving anything away. It's creating the competition that pushes your final sales price above our target. Every day we're overpriced. We're not negotiating. We're sitting and going stale, which costs you far more than strategic initial pricing. Aggressive pricing equals a fast sale and a higher net, and that's how you win in this market. This is your closing argument. It's clear. It's confident. It's backed by data and behavioral psychology, and it positions you as the agent who understands how to maximize their outcome. Sellers who hear this and trust you will list with you, price correctly, and get sold. Sellers who don't will list with an agent who tells them what they want to hear, sit on the market for months, and eventually net less. Your job is to educate them. The next objection, let's test the high price. So let's move into role play scenarios so you can practice responding to the 4 most common objections you'll encounter. Scenario 1, the seller says, I understand the market data, but I still want to test a higher price. We can always reduce it later if we need to. This has got to be one of the most dangerous objections because it sounds reasonable on the surface. Here's your response. I understand wanting to maximize your sales price. That's my goal too. Here's the problem with testing in a buyer's market. With 21% more sellers than buyers, you only get one first impression. 80% of showings happen in the first 2 weeks when your listing is fresh and generating automated alerts to every buyer. If we're overpriced during that critical window, motivated buyers skip us entirely. They don't negotiate and just move on to one of the many other options available. By the time we adjust the price, we burn through the most valuable marketing period, and we become stale inventory that takes 2 to 3 times longer to sell, and ultimately nets less than if we had priced correctly from day one. So let's capture that week one momentum when buyers are most engaged and willing to compete. Price it right now, and let's generate multiple offers that push us above target. That response is firm, factual, and refocuses them on the financial outcome that they want. The next objection, my neighbor sold for more. So the seller says, well, my neighbor just sold her home for $1.2 million and our house is bigger and nicer. Have we ever heard that before? Why can't we get that or more? Well, that's an emotional objection rooted in comparison. You need to handle it with both validation and education. So that's great information you're going to say, and I'm glad you shared that with me. Let's pull up that sale right now so we can look at the details together. So you're immediately showing that you take their concerns seriously. Then you continue. First, when did that home close? If it was more than 90 days ago, market conditions have shifted significantly. Now we're in a documented buyer's market, which changes pricing dynamics. Then dig into the specifics. Need to compare the exact differences. Square footage, upgrades, lot size, condition, days on market, when they got the offer, and maybe just how many times they reduced their price. So even small differences can result in tens of thousands of dollars in regards to what a property sells for. So you need to keep that in mind and remind them there are 21% more sellers than buyers in the marketplace. So the next scenario, price reduction after 30 days. You're calling a seller after their home has been on the market for 30 days with minimal activity, and you need to recommend a price reduction. This has got to be one of the most difficult conversations you can have. But if you have a clear framework, you handle it confidently. Here's what you could say. I want to sit down and review where we are after being on the market for 30 days. We had X number of showings, which is significantly below the typical number of showings that comparable homes in your price range are averaging. The market is clearly telling us we're not competitively positioned. You're presenting objective data, not opinion. Then continue and say, remember, we're in a buyer's market. 21% more sellers than buyers, which means buyers have options and they will not overpay. Every week we sit without serious activity, we become less appealing to buyers because they assume something must be wrong or we'd have sold by now. So now you're stating the consequence of inaction. Then you become directive. I'm recommending we adjust it to whatever their price should be. So and tell them it repositions them competitively and recaptures buyer attention. So the data is clear. Homes that adjust quickly sell faster and net more than those that chase the market down slowly. This framework keeps you in control of the conversation and positions the price reduction as a strategic move. Another one, multiple competing listings. So there's similar homes on the market. So the seller says there are 300 homes for sale on my street right now. Won't that hurt us? Well, should we wait until they sell before we list? No, we want to list it now. So this is actually an opportunity to demonstrate strategic thinking. Here's your response. You're absolutely right. There are 300 homes for sale on your street, and I've analyzed all of them. That's exactly why strategic pricing matters even more in your situation. Here's what's going to happen. Buyers will see all 4 listings and compare them side by side. They'll look at price per square foot, condition, upgrades, and value proposition. We need to position you as the best value so you stand out from the competition. Then you present the strategy. If we price 2 to 3% below those listings, we become the clear winner. We'll get the showings, we'll generate the serious buyer interest, and we'll create competitive offers that push the price up through bidding. Meanwhile, your neighbors who are overpriced will sit and watch us sell, wondering why they're not getting activity. And you close with the following statement. In a buyer's market with direct competition on your street, the best price home wins every single time. So this is our chance to leverage their overpricing to your advantage and get you sold quickly at a strong price. Let's be smart, not a stubborn seller. This turns to be, actually from my perspective, a distinct advantage for somebody if there are other properties that are on the market and they're sitting there. So what we sent out, I think about a week ago, we sent out a copy of the Orange County Register article. We sent out scripts, pricing, or other aspects that you should be following. And I really suggest that you read that in detail. So we, once again, sent the article, a summary, and Carlos pointed out that the summary was just as long as the article itself. I tried to simplify it, but it didn't seem to work out that way. Read that information. So it doesn't matter if you're working with a seller, you're going to be working with if you're working with a buyer. Obviously, all buyers really understand the marketplace and they understand how favorable it is. So when even if you're representing a buyer, what should you be doing? You should be using this information when you're presenting an offer. Why wouldn't you use that when presenting an offer on behalf of a buyer? 2 to 3% below what market value is probably not unreasonable when a buyer's making an offer. But when they're going 10, 20, 30% below market value, obviously no seller is ever going to entertain something like that. But use this information when speaking to buyers, right? We can probably negotiate a great deal at this point in time.
We have a real life example of it. We have an agent that just got a listing, put it on coming soon status. It's probably priced about $100,000 below what the other ones on the market were. And it's coming soon. After one day, they're already getting all cash offers above asking price, 2-week close. They don't care what it looks like inside. We want to buy it.
It works. I'm telling you, people don't want to miss out. Mark just did it. The property has an escrow in Anaheim Hills. He did the same thing. He listed it at $699. I guess just a minute, and it's selling for $797. Sold in a week. He had 45 parties through the house and 1 2-hour open house.
Wow.
Yeah, and he convinced the sellers to price it well below. That's really what he did, and that's what drew so many buyers to the property. And multiple offers. It couldn't have been better.
It works.
Yeah, it works. What were you saying now?
So when you're recommending 2 to 3% below comparable sales, are you talking about sales that have closed or what's on the market right now that are?
Well, I think that's a good question. What's an appraiser going to do? An appraiser can use currently listed properties, for example, when coming to a conclusion, but they usually won't use more than 2 homes currently available. But I would look at what is closed. And remember, 90 days ago, the market since then, it has changed. So I would look at what is closed and go at minimum 2 to 3% below that asking price or that closing price. And then if that's not sufficient, because if you have that much competition, you're going to have to give that consideration when positioning your property as to what the asking price is going to be. But there has to be, if you think about it, you've got a listing coming up, right, for around $2 million. Well, 3% is a lot of money, $60,000. Price it accordingly, and from that perspective, it's going to draw everyone's attention.
So if there haven't been any sales recently because of the winter, the slow time that we had, then how far back do you go to get a comparable sale?
Well, I probably would look at, first of all, what the time on the market was for those. Let's go back 6 months, right? Is that what you're suggesting? Nothing was closed for 6 months?
Yeah, not enough flow back.
Okay. I think that I would still price it 2 to 3% at least below whatever those most recent closing prices were, even though there was some time in the distant past. But you may have to expand your observations when trying to determine what the asking price should be to something beyond that small area per se, 1 or 2 miles. There's usually got to be something within 2 to 3 miles of a property that maybe was similar property type.
Sure, that's what the appraiser is going to do, right?
They're going to have to.
Yeah.
They're going to have to.
What caused the market to suddenly shift like this? Because the interest rate is lower. People are the same.
It's affordability.
But
I don't
again,
think there's
it's just the same. I mean, the prices was high. They were high, 1 year ago. And suddenly everything changes. So
I think a lot of people were holding off selling simply because they didn't know where they would go. But they had these outrageously low interest rates. So that caused them to hold on to their property for a longer period of time. So the average duration of time sometimes that the people are before they sell is increasing. Actually, it's increasing nationwide. But now maybe they're at a different stage in life and they want to list the property, possibly. They are now maybe coming on the market because we're seeing more and more inventory coming on the market. And I myself am finding people that are just leaving California. It's very interesting.
So that could be.
Yeah, there doesn't seem to be any population growth in Orange County on the entire state of California.
No one can afford it.
Yeah, no one can afford it now because what's the median price for a single family home in Orange County? $1,217,000 or something like that. So you need $180,000 for a 20% down payment, and you have to be earning about $250,000 a year. I think that's part of what's caused so many issues, why the market has stagnated as much as it has.
Could it be the economy and uncertainty?
Oh yeah, I think it's all adding to it. Yeah. There's uncertainty in the economy.
Future possible.
Yeah, that's a possibility.
Election 2026.
Yeah, I think in terms of employment, if you think you're going to lose your job, the last thing you're going to do is buy a house. So if there's an uncertainty in regards to employment, that's going to cause people to not proceed with an acquisition.
Yeah.
But sellers, it's not worth it for you to take a listing that's just going to sit on the market forever. What's going to happen? That seller ultimately is never going to sell, and they're going to relist it with somebody else, and they're going to drop the price. So have that discussion with them. You're not losing anything. It costs you time, money, effort to list a property. It is not free when you're listing a property.
I think buyers are being patient too. They're sitting back.
They can
they're
be. They have choices.
Yeah, they're waiting to see.
They have choices, but that's the message that you need to convey. And that article, I think, just laid it out beautifully for all of us to use when we're discussing selling someone's house. For me, it was golden. And of course, what's that golden period of time? The very first 2 weeks of listing a property. That's the time frame you cannot miss out on. So you don't want to list it high and then drop it later on, because they're going to continue to drop the price, and we're going to lose all the interest that we could have had during those first 2 weeks, as a matter of fact. Yeah, it just seems to be the way it's always been. Everybody's just gotten accustomed to the pricing and the price appreciation going back to 2021, 2022, and it just doesn't exist anymore. If we see 0 to 3% price appreciation, I think we're doing very well in regards to the Orange County housing market right now. I don't even know if we're going to see that much. We're probably seeing price depreciation. And I don't know if those red arrows are fair in regards to determining if there's been appreciation or not, because sellers are still just very unreasonable when they're listing their homes. And that is the biggest problem. But that's up to you to tell them. And now we actually have some really good statistics.
Any info in there specifically about Irvine? Because prices are higher than even 6 months ago.
It wasn't in this article, but Irvine, there was another article recently talking about Irvine. Actually, it was comparing Irvine and Tustin, these various cities, and it was a couple of weeks ago at the meeting I discussed this. Irvine no longer is attracting the premium that it once was because of schools. So people are dreaming when they think they can get $250,000 more than a house in Tustin. Now people are gravitating more towards Tustin because there's potential upside in regards to these homes in Tustin versus Irvine now. Irvine has just gotten so overpriced. And of course, what's the whole basis for selling a home in Irvine or buying a home in Irvine? The schools.
And safety.
Yeah, safety.
Police.
All these areas are pretty safe, I would say, but you're not going to get a $250,000 premium for a house in Irvine over a like house in Tustin anymore. It's just not going to happen.
What is that article you said? I'm sorry.
No, it was our meeting a few weeks ago. I'll have to look up the data that I had compiled on that.
I appreciate it.
Sure. Any other questions?
Where we can find the script library?
Well, I'm going to send this to you personally, first of all.
Thank you. Thank you.
I think we probably have a lot of scripts on our intranet. I could be wrong about that. But right now, part of the problem with scripts, if there's no documentation supporting the scripts, I think sometimes the clients look at you and question what you're saying. You still need to know how to handle objections, and the scripts can be very invaluable. But in this case, I think we actually have data now that's supporting the scripts that we've put together for you. So that's the big difference right now, as a matter of fact. Any other questions? Yep. All right. Well, thanks for coming, everybody. We'll send this information out, so please read it over. I think it'll be very helpful.
Business cards.
Ooh.